Hello viewers, welcome back to our YouTube channel, KC Accountancy Education Center. And today we want to look at a new topic. We finished our Islamic finance, and as I had promised you, we are going to start on ethics and corporate governance. So the new topic that we are going to look at is ethics. Ethics and corporate governance. Corporate governance. Ethics and corporate governance. Now, we are now going to go into the details of what ethics is. Of course, we are going to understand what ethics is. But anything you know from the basic point of view, ethics, we just take it as anything that you know you are doing, but it's not morally. It's not morally right. So anything you do, but you know it's not morally right. You know something can be legally right, but it's not morally right. Like for instance, we may be having loopholes within the laws, and someone is going to use those loopholes to either deny a service. Like for instance, someone can use the loopholes within the laws to actually avoid paying taxes. Someone can use the loopholes within the laws to actually commit something that is not moral right. So ethics or ethical issues are those issues that you see. They are they are the normal behaviors. They are things that are believed to be true, even though legally they may not be right. Like something that is morally right. Now, when we are studying ethics, we take it from the unethical issues or the unethical behaviors, because those are the ones we don't want. Ethics is good. We saw the reasons in level 2. We saw the reasons that why companies should operate ethically. They should, one of them, they can attract employees to come and work for them. They don't have legal fees that are going to be paid when they are committing crimes and all that kind of stuff. So they are going to be, if you operate ethically, you are going to reduce the chances of you finding yourself in court cases every time. So we want to understand ethics, but ethics, if you want to get it, just get it from the basic point of view that anything that you do that is not morally right, then it will be regarded as unethical behavior. Unethical behavior. We always look at it from the unethical point of view because that's what we don't want. We don't want people to be doing. Now, when it comes to corporate governance, corporate governance, here we shall be interested in seeing how the company is directed or how the company is run. In other words, when we talk about corporate governance, we are just looking at how the company is directed or run. In other words, how are the operations within the business? So this will be referring to corporate governance. But the ethics, I said, we always, ethics is good. If the company is operating ethically, it's good. But what we condemn is the unethical issues that we shall look at. Now, let's look at the key concerns of corporate governance. But one key thing I need you to note is that here we are not studying the entire corporate governance, because you do corporate governance under your auditing and risks, audit and assurance paper. But here we are just picking out key things, because as the manager of the business, as a finance manager, you need to know at least how the organization is going to be managed. Now, let's first understand the key. Let's look at the key concerns that we need to talk about as far as corporate governance is concerned. Key concerns of corporate governance. Key concerns of corporate governance. Now, as I said, here we are not going to be teaching the whole of corporate governance, but we are trying, or we are creating a highlight to pick out the key concerns. And those key concerns, if you don't take into consideration, if you don't look at them, then you will have problems with your organization. And one of the problems, the company may close down because it has not been managed well or directed well. So we have seen over the years, we have seen very many companies failing. And these companies, they are failing as a result of failure in corporate governance. So as long as the company is not managed well, this organization has very high chances of it failing. Very high chances. So over the years, we have seen very many companies. They come and they close, but their downfall, the main reason for their downfall is part of failure in corporate governance. A popular case, some of these are international companies, others, of course, we shall have some few cases from here in Uganda. We have a company called ENRON. ENRON, it was actually a very powerful company, and this company was being audited by Arthur Anderson. Arthur Anderson. If you try to Google Arthur Anderson, they will get for you the details of who that auditing company was. And by then, it was this Arthur Anderson was the #1 auditing firm in the whole world. But right now, it's no more. It's no longer there because it was liquidated. And the reason as why this Arthur Anderson was liquidated, it was because of the fact that this company had issues. Enron had issues, and these were the auditors. Now, whereas these Arthur Anderson were the auditors, but at the same time, they were the auditors to Enron. But at the same time, they were also providing consultancy services to the same company, Enron. There were the auditors. Of course, when I'm talking about the auditors, I'm not meaning the internal, they were the external auditors. But at the same time, they were providing two services, auditing, and at the same time, they were providing consultancy services. And what happened, since Arthur Anderson was providing consultants, at the same time, it was also providing the auditing, the managers and the public were relying on their information. They were relying on their information in terms of the reports they have prepared. So the public was relying to the reports, and even the company was relying to the reports that have been submitted by this Arthur Anderson, the auditing firm. Now, what Arthur Anderson was doing, the auditing firm, what it was doing, it could manipulate. They could manipulate all doctor accounts. They could forge. So what this auditing firm did was to manipulate the records, and they ended up publishing financial information that was wrong. And remember, the public was basing on their information to make their own decision. Even investors, these guys, they published wrong information, and they brought investors to come and invest in Enron because they published wrong information, in a sense that they attracted more investors. In other words, the accounts were overstated. Even the profit was overstated, even the dividend per share was also overstated. So they looked at the Enron as a company as being a very profitable company for any investor. So investors relied on the information that was prepared by the Arthur Anderson, the auditing firm, to make sure that they invest in this company, Enron. But of course, you know, as long as you lie, people, when they bring in their money and they don't see the return, companies collapse. The problem would have been maybe this Enron wouldn't give. You can't be the same person. You are the auditor, but at the same time you are the one who is providing the consultant services. Consultants may be in terms of looking at what the organization can do. Remember, the whole organization was relying on the information that is manipulated, but they don't know. So that's how the organization collapsed. Even Arthur Anderson also, it was liquidated because it turned out, of course, when you go through the other corporate governance under auditing and assurance paper, you will get the detailed analysis of some of these companies. The other that we can talk about, please take note that these examples we are highlighting and the scenarios that we are bringing, they are the same scenarios that are going to appear in your exam. They may just bring a case and it is just rotating around. They are bringing things that maybe we had the ABCD, it was doubling as the auditing firm, and at the same time it was providing consultancy. It attracted, you know, such kind of story. So those kind of narration is where we will be able to pick the points and be able to analyze what they are talking about. That's why I'm giving more examples. The other that we can talk about is Barings Bank. Barings. This Barings Bank in Britain, this is UK. Now, this one also had the same issue. You can read about, you can, even if you just go and search about this same company, they will give you what happened and what was the result of its downfall. The other, now if we talk about the Ugandan kind of stuff, we had what we call the International Credit Bank. They used to call it ICB, International Credit Bank. It was owned by, I think, Kato, Mr. Kato. It's called Kato, something like that. But this company also collapsed. We also had the Greenland. These banks were there. Greenland Bank in Uganda. Then we also had the known one, the one that was for the government, the cooperative bank. The cooperative bank. This cooperative bank is now the one that we call Stanbic, because it is Stanbic which bought off. It is the present day called Stanbic. Stanbic which bought off the assets of the cooperative bank, but it was a government entity. So Stanbic bought it off. So all these, they declined because of corporate governance and ethics. As if you go through one by one, you look at what happened, what were the things that these guys were doing, you will see that it actually collapsed because of corporate governance and ethics. Of course, currently we have things to do with the Crane Bank, also Crane Bank. The Crane Bank that was sold to the FCU. Crane Bank. So, Crane Bank, and also even Uganda Telecom. You see, Uganda Telecom has issues, even though they haven't sold it. Uganda Telecom. Just imagine if because all government employees, before the government could employ you, you are supposed to first have a UTL line. UTL, Uganda Telecom. Just imagine if at all they had very many products. Remember, it was compulsory for all government workers to actually have these numbers. Just know how many civil servants are there. Those who were there, those who are now being recruited. If it had so many products, and it also goes to the private sector, would be having more. UTL would be like the likes of M10, because it was the first one. It was there for long, and it had some monopoly over, because every employee of the government was supposed at least to have a line before they give you the job. So we also have things to do. There is this Nakumat, I think. Nakumat. Not sure about what happened to ShopRite, but it could be. So all these, most of these companies, they nearly collapsed. Like the Uganda Telecom, of course, it collapsed because of. If you look at what happened to Crane Bank, there were very many staffs. The stories of the fact that we shall look at some of these. The chairman, board of director, was a non-executive, was not related to the business, but the assistant chairman, board of director, was the owner of the business. So what do you expect? Do you expect the chairman to override the decision of the owner, even though the chairman was a non-executive executive director, which is what is recommended. But the assistant chairperson or chairman of the board of directors was actually the owner. So what do you expect? It's like the owner coming in just to see who should I fire and who should I attain based on the decisions they have made. Because there is no way you are going to overrule what the owner has said, even though you are the chairperson board of director. So they just put you there just to fulfill the requirement that actually the chairperson in a good way is supposed to be a non-executive director. So you have a non-executive director as the chairman, but the assistant is executive director. What do you expect? Especially now, given the fact that he's the real owner. So like he just puts you there, you just hold the position, but the powers are not with you. So those are some of the things that, because now if this happens, then you just know this person is not good. The chairperson is not going to exercise his or her independence. Remember, the reason as why they are bringing in non-executive directors to be the chairpersons is because they want them to bring in that kind of independence. Because when they are voting, you need to be having someone who doesn't care, but he's just doing the right thing. But here, it's like there is already an influence if the assistant is the real owner. So, under corporate governance, when you look at the principles under corporate governance principles, for instance, as I said, for the principles for corporate governance, one of the principles is the fact that the chairperson board of directors, for you to understand this, you must be well equipped with the agency relationship. Where we said for agency relationship, we know that we have the shareholders. These are the owners of the business. But now, since the owners can't run the business, even though they have money, they can't run the business on their own. So what they do, they appoint the board of directors. When they appoint the board of directors, these board of directors, they are also not employees, meaning they are not going to engage themselves in the day-to-day running of the business. So what is going to happen is the fact that these board of directors, they will choose what we call the CEO, the Chief Executive Officer, or the Managing Director, the MD. These ones are going to these ones employ, or they can also appoint. But remember when we said we looked at agency relationship and in our financial management on level 2, we said there is that first relationship of the shareholder and the board of directors. Here you appoint. The right word is they appoint. So once they appoint you, it means the board of directors are going to be the agent and the shareholders are going to be the principal. Remember, I told you when you're explaining the agency relationship, you make sure you show the agent and the principal. That's the principle for you to actually get the correct mark for explaining this. Then also, when it comes to this, the board of directors and the CEO, these ones, they can also employ or appoint. But this one is going to be the agent, and this one is going to be the principal. So this is what is going to happen. I don't want to explain more about what is done, but I just want you to understand the fact that under the board of directors, we have two types of board of directors. We have what we call the executive directors. Executive directors, those are like the people who have real connection to the business. If the business is failing, they are panicking. In other words, they have a higher interest in the business. They have some interest. It could be maybe these are relatives of the owner. These are maybe brothers and sisters of the owner. It could be other family members and other people, or the spouse. Those are the ones that where the owners pick what we call the executive directors. But the non-executive directors, those are the people who have no interest. They are not connected to the business at all. So what happens is that the reason why we are supposed to have the principle for corporate governance is that you should be having more non-executive directors on the board of directors than the executive. Reason being, these non-executive directors are going to bring in what we call the independence. Because here in the board of directors, communication is always done under the board meetings. And when they are in board meetings, they are supposed to vote. You vote against or you vote in favor. So if you don't have more non-executive directors, the implication would be these people will just influence the decision that is going to be made, even if it is not right. So one of the principles for corporate governance, it says that you should have more non-executive directors than the executive directors. 2, they are also saying that the chairman board of directors must be a non-executive director so that he brings in that independence. Now, look what happened to some of these companies that collapsed. I've explained to you what happened to GREENLAND Bank. The chairperson, board of directors, was a non-executive director, which was okay. But below, the assistant was actually the real owner. So it was contradicting, because there is no way the chairperson would vote against his assistant, who is actually the person who employed him or her. So even if these shareholders are going to be choosing, you need to, if they don't follow the corporate governance, then it means the company is going to fail, because no one is going to be voting against the bosses or the executive directors. I will explain something like for what happened to the Ugandan banks, like for the International Credit Bank. International Credit Bank was owned by, I think was called Cato. Now, was the owner. This was the owner of that ICB bank. Now, what happened in this bank? The owner, which is Mr. Cato, was actually the chairperson, the chairman, board of directors. And to make matters worse, his children were executive directors, meaning no one could vote against. So his children were executive directors. So there is no kind of independence here. You don't expect a son to vote against the father, and you don't expect the father to vote against their son. So what is going to happen? They will just accept even if it doesn't actually help. That's why when they are choosing some of these, especially the non-executive directors, they choose people who have experience in managing companies that are relatively of the same size, like what they are appointing them for, so that they bring in the exposure and the kind of independence. And that's why we want to have more non-executive directors than the executive directors. And that's the reason, to make sure that someone can stand firmly and say that is not going to help the organization. I explained what happened to GREENLAND Bank. The chairperson was a non-executive director, which was a tick. But the assistant was actually the owner. It doesn't make sense. So we have these kind of, I'm just really bringing in just the key concepts that I need us to deal with. And these are some of the things that they are going to quote in the case, and then they tell you to advise. So now we want to look at the international. Remember here we are basically looking at the entire. This is an area of international concern, corporate governance. So we want to look at what happened in different, or how can we be able to manage the organization well. Of course, in the UK, in London, they had a committee. A committee was formed to come up with standards on how a corporation or on how a company can be run. And the person who was like spearheading was called Chadley. He came up with a report on corporate governance and made very many recommendations. Even in South Africa, this was in London. Then also we had some recommendation from South Africa. Now, for South African case, it's most of the times what we are basically using. And I will tell you why. In South Africa, at the highest peak of apartheid, that apartheid period, there was a judge, a high court, actually was a high court judge, was called King. And what happened was, when the whites lost on apartheid, they said that they tried to focus on companies. They decided to transform companies and they become a more organized place. That's why we are seeing most of the times, most of the companies, they are coming from South Africa. It was as a result of apartheid, where they sat and they concentrated, they tried to transform companies. So by transforming companies, this judge, they wrote reports and they made numerous recommendations on how companies can be managed, because most of the companies were destroyed. So they wanted to try to find a way how they can come back together. So they had to get those recommendations. So we have that high court judge called the King made some recommendations, and the first recommendations, they are the ones that were in the report, which they called the King 1. It was also then modified to King 2. And finally, this King 2 was also transformed to King 3. And it is this King 3 that is still relevant, or that is recently used. But also, when we talk about the Ugandan aspect, we also have things to do with corporate governance. In Uganda, we have the Institute of Corporate Governance, and they have also made some recommendations. And we also have the Commonwealth Also, the Commonwealth made some recommendations, but the recommendations of Commonwealth were more like the ones that were recommended by Chadibale. So the Commonwealth reports and the Chadibale reports were taking almost the same side. So they tend to follow, the Chadibale report tended to follow the Commonwealth report or recommendations. But as you go into your auditing, you'll learn more about that King report. Even if you try to Google, it is a very big document, but you pick out, you look out, you go into the table of contents and you pick out the recommendations that were made.